Hello everyone, today on The Final Bar I'll be talking with Adam Turnquist of LPL Financial. We'll look at some of the charts that he is using to track this interesting environment in stocks. The S&P 500 continuing to test 4,300 but really not following through just yet. Ladies and gentlemen, this is The Final Bar. Hello everyone, welcome to The Final Bar. I'm your host Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the best practices of technical analysis. The technical toolkit is designed to help you really understand and appreciate the value of analyzing price behavior. Investor behavior translates into price action. Price action, by analyzing that, by focusing on trend and momentum, we can better understand, really learn the lessons of market history and appreciate the dynamics that are happening right now. Now, here in the Pacific Northwest or in the Seattle area, pretty far north. And so what happens this time of year, the days are getting very, very long. So I got up this morning around 5:30 a.m. The sun was getting up with me. Sunny times in Redmond, but is it sunny times for the market? The challenge right now is we are testing the resistance level, not just a kind of resistance, but arguably the resistance at 4,300 to 4,325 level. We've focused in on that for quite some time. A number of our guests over the last couple months have sort of looked far up to 4,300, 4,325. We're there. So now the question is, do we have enough momentum, enough mo to power through that resistance? I would say that's still very much an open question when you have stocks like Meta and other leadership names starting to pull back a little bit. Is that enough? Do we have enough of a rotation away from the growth leadership to stall out at this key resistance level? Let's look at the charts today in our market recap and let's see what actually played out, what that tells us about how today relates to the long-term trends. The S&P 500 opened a little higher, and as I was first looking at the market right out of the open, you saw the surge right back up to 4,300. So as many days recently, I've thought, all right, is this the time where we really power above 4,300, get above this resistance range? It was not to be today. As some would say, it might be someday, but that day is not today. So what happened is we rotated lower. We actually made a low for the day around 1:30 p.m. Eastern, and then finished at the lows of the day, around 42.67. That brings the S&P down about 0.4% from yesterday's close. So don't get me wrong, still near the highs of the year, but not really following through to the upside. We're stalling out a little bit. I would argue a lot of that has to do with the sector movements today, right? The leadership sectors today have not been the leadership sectors so far in 2023. We'll come back to that. Put a pin in that comment. We'll come back to that in a moment. The NASDAQ composite leading the way lower, down 1.3%. The Dow higher, up 0.3%. So we have a familiar scenario where recently, where the NASDAQ is down, the Dow is up. But of course, the S&P is most likely going to be down in that scenario because it's pretty growth oriented, all things considered. Mid caps and small caps had a decent day, with the small cap S&P 600 up 2.4%. So if you think about what prevents the S&P going further, days where the small cap index is up over 2% and the NASDAQ is down over 1%, that's not going to be the day we're really able to follow through. The VIX, by the way, even though the S&P was down a little bit, the VIX actually moving lower, now down below 14. Again, we are now firmly down in the range that we were back in 2021. 2022, a period of much more elevated volatility. My guest yesterday, Ryan Dietrich, we looked at the VIX in a little more detail. I thought he had some great thoughts about what a low volatility environment may mean. So if you missed that interview yesterday, check it out on our YouTube channel. You can get Ryan's thoughts for sure. Looking at some other asset classes before we continue on looking at the equity space. Interest rates, for the most part, moving higher. The short end of the curve remained relatively stable. 5, 10, and 30-year points all pushed to the upside. The 30-year yield is getting closer, back up to 4%. End of the day around 394. The 10-year yield around 378. The dollar index, no real change from yesterday. So you basically saw bonds sell off with the TLT down about 1.5%. That, of course, means interest rates are moving higher, and that's the environment we had today. Also moving lower, Gold and silver, precious metals. We're going to look at the chart of gold here in a moment after the S&P, because I think we may be able to declare that we've broken down out of this trend channel we've been tracking here for a number of months. The last 4 to 6 months, gold has been in a nice sort of steady incline, moving higher, higher highs, higher lows. That may be starting to change. We're certainly breaking below trend line support this week. Silver moving to the downside as well. Other parts of the energy space doing fine, or commodity space, particularly energy, with crude oil prices moving higher. Energy having a decent day as well. Cryptocurrencies remain probably the most volatile part of the market. If you like volatility and uncertainty, I'm sure you're very much enjoying 2023, and certainly the last week or two with Bitcoin and Ether. Both of them down today. Bitcoin down about 3%, Ether down 2%. We talked earlier this week just about the general issues, what I call the regulatory risk, volatility risk. These are issues that we're running into right now. The regulatory risk, there's always this risk with a very lightly or even unregulated asset like cryptocurrencies, that some regulator jumps in and wants to, obviously, batten down some sort of regulations on this space. We're getting that, and so that of course is going to put some downside pressure on cryptocurrencies. So for now, we're seeing Bitcoin pull back after yesterday's move back to the upside. Let's look at a chart of the S&P 500, just check in on where we're at today. So this pink shaded area is that 4,300 to 4,325 range. Now again, 4,300 to 4,325 comes from really two main things. Number one, the August 2022 high. You may remember the NASDAQ composite, of course, has already moved well above its February high, pushing above these levels. The S&P is now above 4,200, above its February high, but now testing resistance at the August high. What's interesting is if we break through this, I would argue what's left going back to 4,600 and even after that 4,800, sort of going back to the all-time highs. And the answer is not much, right? I would argue that the August highs, so many people are keying in on that because it's a clear level of resistance on the chart that we've not made it to yet. If we get through there, there's not much left above there until we get back to all-time highs. Now, the other thing about 4310, 4325 is that it also represents a 61.8% retracement from the October 22 low back up to the January 2022 high. I think that's pretty significant. So two things I would expect. Number one, you would most likely expect a stall, if not some sort of pullback from a level of significant resistance, because so many people are expecting it. The other thing is, if and when we do break above 43.25, that feels very much like a lights out rally sort of environment. But we need upside momentum. We need stocks that are going to be able to lead the way higher. I don't know if we've certainly seen that yet. I want to bring up a chart of gold here because we've focused on gold recently. We actually looked at the GDX, I think it was last week, and focused on a trend off of the lows. I'm bringing up the GLD right now. So this is an ETF that's really a play on spot gold, not on gold stocks, but on physical gold. And if you draw a trend line from the November 2022 low to the March 23 low, you can see that lines up with where we've been over the last couple weeks. And today, another drop for gold. The GLD was down about 1.2%. Now testing back the lows we set about 2 weeks ago. In late May around 180. If we hold that, that's encouraging. But if we break that, all of a sudden I think that completes this rotation out of this trend channel, arguably, and now more of a downtrend phase. Also worth noting, the momentum has been fairly stable in a positive phase. Not breaking much below 40 on any sort of pullbacks. Keep an eye on that because that's where we're at today. So do we hold an RSI of 40? Do we find support at 180? If both of those say no, I think gold is now maybe in a confirmed downtrend. And then you want to start looking at a trend line off of the highs and wait for a break above there to indicate more of a rotation higher. But this sort of plays into that risk on environment, right? Gold, a fairly defensive area of the market, starting to struggle. Might be an interesting data point to pay attention to. Now, energy, the top performing sector today, the XLE was number one out of the 11 S&P sectors. We've talked about this rotation away from some of the growth leadership that's been arguably the story in 2023 and into some of those beaten down sectors like energy, like financials, even things like utilities, which are starting to actually show some signs of life. What's interesting about the XLE is we're finding a bit of a bounce off of support. The lows in March around $75. You can see this week we're bottoming out up around 76 and starting to rotate higher again. We're not back above the moving averages. I think that would be an encouraging sign if you're on the bullish side of energy, but overall, maybe finding some stability there. And again, up over 2.5% today. If you look at some of the names within the energy sector, two that I'll highlight, a chart like Marathon Oil shows you that while the recent rotation is encouraging, is it really an obvious break to the upside? I would say not yet, right? Marathon Oil is not going down anymore, but I would say from a trend following perspective, it's really not going up yet either, right? What do we need to see? Well, we need to start making higher highs. We've made a higher low. That's encouraging. Around 22. Can we make a higher high? Get above the mid-May high? Can we get back above the 200-day moving average, which is around $26? Not yet. Now, that's an integrated stock. You can look at E&P stocks as well. Chesapeake Energy. CHK, again, finding support around $73, $74 over the last month or two, but now again testing short-term resistance. So a lot of these energy names, while leading over the last week or so, not really yet getting above resistance. However, I think those are the charts to watch to see if they can follow through. That might be the sign of a real change in leadership. Semiconductors, of course, represent an important area to watch. When I'm looking at the SMH, these stocks obviously had an incredible run through mid-late May, overbought the last week in May, and now stalling out, no longer making a new high. And within that group, you have names like AMD, which looks a lot like the SMH or the SOX index, a gap higher about a week and a half, 2 weeks ago, moving up a little bit, but now right back to support. We break into that gap range. That might tell us that we're starting to break down after this rally to the upside. But you also have charts like Applied Materials, AMAT, with a nice break above 125. That was resistance in the first quarter. We've now broken above there, and overall, we're holding in okay. We're still making higher highs and higher lows. What's great about the technical analysis discipline is, in my opinion, it's not about predicting the future. It's not a crystal ball. Carl Swenlin, one of our longtime StockCharts contributors, would say technical analysis is not a crystal ball. It's a windsock. It tells you the overall trend, right? It tells you the momentum out there, but individual days can have a lot of movement. So step back and look at the overall trends. When a stock like AMAT is no longer working, the chart's going to tell you because it's going to stop going higher. Feel free to stick with trends that are working until proven otherwise. We need to take a quick break. We'll be back with today's guest, Adam Turnquist of LPL Financial. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We are so excited you're joining us here on StockCharts TV for the Final Bar. We are excited with the plans for this show and for StockCharts TV through the course of 2023 and beyond. So keep an eye on StockCharts.com and StockChartsTV.com for some great updates on what we'll be doing with our programming going forward. I want to make a couple quick announcements before I bring on Adam Turnquist, today's guest. First off, we welcome your questions. We'll do a mailbag at the end of this week, and we love to answer one of your questions live on the air. Our email is thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts TV YouTube channel. We'd love to hear from you. Hope to answer one of your questions live on the air on Friday's show. Upcoming guests tomorrow on June 8th, Thursday, we have Willie Delwich of High Mount Research. On Tuesday of next week, June 13th, helping us prepare for the Fed meeting, we have Gina Martin-Adams, who's the chief strategist at Bloomberg Intelligence in New York. Then we have the Fed meeting Tuesday into Wednesday. Wednesday will be Fed Day. We'll talk about the sentiment leading into the Fed meeting, the press conference afterwards, all the volatility, all the uncertainty, what questions we can answer. We'll go through that together next Wednesday, the 14th. I want to bring on today's guest, Adam Turnquist. Adam's the chief market strategist at LPL Financial, coming to us from Milwaukee, Wisconsin. Adam, good to see you. How are you?
Hey, thanks for having me on, David. Great to see you.
It was awesome to see you for the CMT Symposium in New York. It was such a pleasure to reconnect with you. I'm so excited to bring you and your expertise on, share it with our viewers here. We're starting with your chart of the S&P 500. We're testing the significant resistance, right? We broke above 4,200. Now it's the 4,300 sort of range. What do you see now looking at the big picture?
Yeah, so our big picture is a theme going with Clint Eastwood here with the good, the bad, and the ugly. So we'll start with the good. And that good news is that we finally cleared that 4,200 resistance level that I think every technician has been talking about. It took at least 10 tries to get through there. But unfortunately, the bad news is that we are bumping into that 4,300 resistance level, which is just overhead right now. So not a lot of room to run until we hit that major area of resistance, which you highlighted earlier on the show. That goes back to the August highs and a key Fibonacci retracement level of last year's bear market. I think that's going to be a pretty hard hurdle for the market to clear. That gets us to kind of the ugly news of the technical story, and that's basically breadth. You can see on the bottom panel the divergence that we've seen in participation in this rally. We've had fewer and fewer stocks above their 200-day moving average, while price is moving higher. Not exactly what you want to see when you're going into a key area of overhead resistance. If you look back to February, you had nearly 80% of the S&P 500 above their 200-day. Compare that to today, just over 50%. However, we did see a little bit of a rebound just over the last few days, with small caps catching a bid finally, even energy and financials. Those have been two major sectors dragging on market breadth, but I think it's really too early to make this a call for a broad-based rally. So I think you have to keep that bull market champagne on ice for now.
I love it. It's interesting. You mentioned the breadth conditions, 100% agreed. And you mentioned how small caps now starting to rotate higher. The S&P 600, strong day and led the S&P today, for example. It's so interesting because I was taught small caps tend to lead in a bullish phase and they tend to lag in a bearish phase. We're almost experiencing the opposite in 2023, right? The market's rallying and small caps are underperforming. The small cap index starts to rotate higher just as the S&P's topping. Why is that script sort of flipped here this year?
Yeah, I think it's just to the point of a mean reversion. We've seen such an extreme with that large cap growth trade outperforming small cap value. And I think when you look at valuations, they're getting a little bit stretched in that large cap growth space. They're certainly cheap on the smaller cap value side. So I think, we're seeing some maybe bottom fishing coming in. Even if you look at the Russell 2000 versus the S&P on that ratio chart, you're actually back to those pandemic lows. So again, too early to make the call for a full rotation, but certainly something we're watching closely here at LPL.
Now, your second chart is getting into one of the strongest sectors so far year to date, the technology sector. When you're looking at tech, signs of optimism, signs of pessimism, and why? Talk us through this one.
Yeah, so on a long-term basis, still bullish tech. This has really been the main engine of this year's rally, and it looks like we're overheating a little bit. You can see on the price action just over the last few weeks, we're pretty extended above the 50-day moving average. The bottom panel, you're at a 10% premium. Above that 50-day moving average, if you look at RSI, even on the bottom panel there, you're actually at your highest level last week since December of 2021. Not a great analog. And then even when you look inside of the tech sector, you had nearly 30% of the sector overbought last week. So when you look at the overall technical evidence, certainly can make the case here for a potential pause or a pullback. I'm not going to bring up valuations because you probably won't invite me back on the show, but the sector's trading at 2 standard deviation above its longer term forward PE as well, just to mention. So this is really more of a tactical call, not a bearish call. So we think there's a better entry point for tech on the horizon. And I think that's definitely, the read-throughs into the broader market, just given how much tech has carried the broader market this year, certainly would suggest we could see a pullback on the S&P 500 as well.
This is a beautifully constructed chart on our ACP platform, Adam, and thanks for that. I'd love for you, if we could just digress a moment. RSI is an indicator I use often, so I know our viewers are super familiar with the overbought conditions and what that means. We don't often look at how far the stock or the ETF is away from the 50-day, which is that panel. Can you talk about what that represents and why this sort of, why we're so far, what that actually represents for the dynamics of the stock or of the ETF?
Yeah, so this is just dividing price by the moving average here. And I've been taught think of it as like a rubber band getting stretched. And in general, it only stretches so far until it snaps back. And you can see on the chart here, it doesn't really get beyond that 10% threshold. Even, back in August when tech went on a huge bear market rally, you got right around that 10%, and then that rubber band came back and snapped. And I'm not saying that's the case, what we witnessed in August, but certainly raises the question for at least a consolidation phase or a potential pullback here for the tech sector.
That rubber band metaphor is fabulous. I will take that and give you full credit for it. That's a really good one, Adam. Thanks for that. Another group that's done very well is home builders. Home construction index is what we're looking at here. Strong group, and a lot of the home builders like Lennar and Toll Brothers and others having another pretty decent week. What do you see in this chart? What do you like or not like here?
Yeah, I think this is first of all, a great example of price leading fundamentals. Also a great example of why technical analysis works. Again, no crystal ball. but certainly a pretty good story here on the technical setup. The home construction index was down 40% last year, finally put in a low back in June of last year. And then we started to see higher lows develop right around the same time that the 10-year yield actually topped out back in October. And that's really when we saw an acceleration of relative performance compared to the S&P 500. And that uptrend looks like we have more room to run. The economic data in the housing sector is starting to improve. Home builder sentiment looks like it bottomed back in December. So certainly some signs of an improving economic backdrop for the housing sector. And it's already made it this high on bad news. We'll see if the momentum here can continue. Looks like we'll probably go back and retest those 2021 highs. So another maybe 5 to 7% of upside. So definitely think there's more room to go, especially if the Fed pauses next week. Historically, that's been a good indicator for falling 10-year yields and mortgage rates.
I feel we get a lot of questions when something like home builders or semiconductors or gold stocks until recently have had such a strong run. People are nervous about chasing something that's already moved so much. And I feel like in some ways, buy low and sell high was probably one of the worst things people internalize because they're afraid to buy when things have rallied. Can you just give us your take as to why you should be okay? What's the benefit of buying something that's showing strength as opposed to buying into weakness?
Yeah. So, it all goes down to momentum, and momentum's been a proven factor in terms of investing, whether it's academic or technically. And this trade definitely has momentum behind it. You can see on that ratio chart, you're actually breaking out from a multi-year base going back to now. I think even today, we're highest level since 2007 when you compare it to the S&P 500.
Wow.
And that's really what you want to capture as a portfolio manager, as an investor. You really want that relative strength and momentum and relative strength. And I think with the home construction index here, you're getting both on an absolute basis and on a relative basis.
That's really well said. That relative strength line is so important. And I know from time working with institutional investors, we always said that's the line we're paid on. And I have tried to encourage people as much as possible, focus on relative strength. There's so much good opportunity with things that are working. Going back to your chart of the S&P 500, you sort of mentioned or you implied, sort of limited upside, right? We're sort of facing this huge resistance. What would you need to see on this chart that would maybe flip you to a less encouraging sign? What would turn you bearish? Is it a breakdown below a certain level? Is there an indicator or a pattern that would emerge that you would say, okay, that clearly is not going to work, and now we need to sort of get defensive? What would you need to see here?
Yeah, I think if you start taking out, call it the April lows right around 40.50, or even maybe the 50-day moving average where, this buy the dip mentality doesn't show up. We did see that in December. We saw that in March. So we need to continue to make higher lows as part of the definition of an uptrend. So if we start putting in lower lows here on a deeper pullback, it'd certainly be a cause for concern. And then even on the macro side, what's going on with interest rates and the 10-year technically right now, we see that as in a downtrend. If that reverses, certainly weighing on equity markets as well.
Adam, you clearly have an incredible command of the technical analysis toolkit, as we know. Talk about how you approach next week, which is the Fed meeting, a lot of uncertainty. The expectations for the Fed have been very fluid. I feel like it's been an obvious they'll continue to raise, then an obvious they won't. How do you sort of prepare for that coming next week, and what are you looking for or listening for with sort of a market-moving potential week?
Yeah, so we have Tuesday CPI report. That's going to be a key factor next week, and I think moving some of the implied probabilities around right now in terms of expectations. Last time I looked, we were maybe around 35% probabilities for a rate hike in June, but much higher when you look at July. So I think the fixed income market is certainly suggesting that we will have another 25 basis point rate hike. I think the equity market has already moved on and either pricing in a pause, or they're more, looking at clarity from the Fed, knowing that terminal rate is finally on the horizon, at least on a near-term basis. So, if we did certainly get a more hawkish Fed, I think that could be a trigger for a deeper pullback or a more acute pullback within the technology sector next week, just given its sensitivity to interest rates.
We only have about 30 seconds left, but energy, the top performing sector today, Adam, and a lot of these names have been beaten down, underperforming, but now starting to rotate higher. Have you seen enough to think you want to lean into a sector like that, or is it still a wait and see mode in your opinion?
I think it's wait and see right now with energy. We're neutral on the space, and then even when you look at crude oil and what's going on there, I think it's just a bottoming process with WTI futures. We have not had that confirming breakout with WTI. Certainly on our radar in terms of a potential, investment opportunity, but not enough technical evidence right now to get in there and go with an overweight.
Adam, this has been awesome. I appreciate you so much coming on, sharing some charts, sharing some expertise with us. Be well there in the upper Midwest. Enjoy the summer, and we'll talk to you again soon, all right?
All right. Thanks, David.
That's Adam Turnquist. Adam's the Chief Technical Strategist at LPL Financial, coming to us from Milwaukee, Wisconsin. I feel like I could talk to Adam for an hour, if not many, many more hours, about all the interplay of these different disciplines. What I love about Adam and his approach, if you think about it, it was chart-focused, it was chart-oriented. He's looking at what the patterns are telling us. He's looking at breadth conditions. He's looking at measures of extremes like percent away from moving average and other metrics, but also thinking about the big picture. What does that mean relative to the Fed meeting? What does that mean relative to valuations? I think Adam's conversation there represents, I would argue, what a holistic investment process should sound like. That was well done, and I appreciate it very much. Adam Turnquist from LPL Financial. We've got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I can't help but key in on energy, financial, some of these sectors that have been struggling, really starting to rotate to the upside. And while I think there's still a lot to prove, you're seeing in the short term a nice rotation higher. Right now, we're looking at a ratio of 2 different ETFs. This is the RPG and the RPV. Now, you may not be familiar with these, but this is a different way of just looking at growth versus value. A lot of stocks actually are double counted. They're considered both growth and value because they kind of fit the definitions loosely in both cases. This is just looking at stocks that are purely growth, purely value. So think of like an emerging technology stock as a classic growth opportunity, a very defensive like utility or staples as a value play. Look at how this ratio has started to rotate lower. We highlighted on our show yesterday offense versus defense, the XLY versus the XLP, the equal weighted versions of those ETFs rotating higher as well. This is sort of that chart flipped over where you're seeing growth, which had been certainly the strongest part of the market through May, started to rotate lower. And while I think, again, it's still early on, you're seeing a rotation away from the mega cap stocks that have really defined the uptrend in 2023. I would argue, if you ask me what would prevent the S&P from getting above that 4,300 resistance level, I would say this kind of ratio rotating lower would have me the most concerned. Chart number 2, the utilities sector. Now, this is the relative strength of the XLU versus the SPY in the top. This is looking at the price of the XLU in the middle, and then the RSI, measure of momentum, on the bottom. I had a number of questions about utilities bouncing out of an oversold region, and we see the bounce in price. And the question was, does this mean the bull market's over because utilities are starting to work? Let's not get too excited just yet. I think Adam Turnquist's comments about the importance of relative strength is super important. So take a step back from your monitor and look at the trend over the last 6 months. You can see how utilities have still been underperforming. That bounce we've seen in the month of June is this little blip at the end of the relative strength. If that continues, and if you continue to see investors rotate to defensive areas like utilities and real estate, then I think we potentially have some cause to worry in terms of this as an overall indication. But for now, I think it's still a little bit too early on. Utilities, sectors like utilities, and especially staples start to work, then I would be concerned. I mentioned in the market recap in the introduction stocks like Meta and others. I just want to highlight a candle pattern that I saw here on Intuit, right? The software group has been one of the strongest. Technology sector, the XLK, has been incredibly strong. The NASDAQ, of course, dominating the S&P and certainly the Dow. Yesterday, we have what's called a shooting star candle, and that on its own is not the only thing. What happens is that is occurring right at a established level of resistance. Key candle patterns tell you about short-term dynamics. Resistance levels tell you about longer-term levels that are meaningful for the stock. So today's drop, I think, could have been anticipated based on yesterday's shooting star candle. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. All of our previous interviews can be found on our YouTube channel and at StockChartsTV.com. Special thanks to Adam Turnquist of LPL Financial. I'm Dave Keller at StockCharts. Have a great night.